Hello, Sense of Things. It's Jeff and Ron once again with another week of fun, fabulous economy and markets and some fun facts to make you laugh. So, welcome to the show, my friend.
Good morning. Hey, don't blink. 1/6 of the year is over. It's March.
Wow. I have a little chart behind me in my office where I pull things off of it. So it's just basically a big chart where I pull sticky notes off, and it's my goals and what I'm trying to accomplish. And I'm looking at it and it's, my God, it's there's not much left on this for the first quarter, which is just unbelievable this
Hey,
year.
I still remember doing our holiday show in December.
I know it seems like it was yesterday, but boom, we're almost 3 months out of the year already and heading into the second part. So interesting.
I know.
I'm sure you've got some fun facts for us
I
this week.
do. I do. And in popular demand for the last couple of weeks, people love our bad business decisions and bad product logoing and design and all the other stuff. So let's just continue the trend here. We got a couple of new good ones. So maybe they should have reversed the words on this pencil when you're sharpening it.
I
mean,
love
if they
it.
would have just gone the other way with it, starting from the eraser side, it wouldn't have been too bad.
It would have been better. Yes. Wow. Yep.
Another bad design. This is a platypus, the ugliest animal in the world. It's
Yes.
a platypus tea diffuser, and this is available on Amazon for those of you that want to check it out for yourself.
Wow. Yes, just please don't use any kind of a reddish tea, apparently, because it looks like he's dying.
I don't know. I don't care what color tea. It's not going to be diffusing in any desirable way. That's all I'm saying.
And I'm still trying to figure out the platypus. I just, once again, the ugliest animal ever. Why would you have that as a tea diffuser? I have no idea.
I don't know. I'm sure there's a lot of other bad ones to choose.
I'm sure, but
this is right in the mix. Okay. So another bad design, and should have fixed the dispenser. These poor minions. So my whole point is, typically the spout's going to come out the head.
yeah.
Why is it bleeding from the eyes?
Yeah. Wow.
You can see on the bottom, it says it's a 3-in-1. A body wash. This is for the parents that don't want to take their time to bathe their kids.
Yes.
It's a body wash, a shampoo, and a conditioner.
I love this. Okay.
Right. So
yes.
I don't get this design.
With
probably available on Amazon
with a bloody minion bleeding out of the eyes. Okay.
Yeah, they went from cute to creepy. What can I tell you?
Exactly.
All right, and who developed the mascot for this product? That's what I really want to know, folks. I understand it's supposed to look like in somebody's intestine, but for what this product is for, it does not look like intestines.
No, looks like a big pile of poo with eyes.
Now, if there was steam coming up from it,
that may have been a little bit more reflexive of what it is. So.
And I'm sorry, the answer is no to this product.
Tastes like grandma.
I mean, I like jams and jellies, but no, the answer is no.
I don't want no grandma tasting.
Maybe, if it really tastes like, it smells like grandma, it'd be mothballs and camphor.
Yeah, that's true.
My jams and jelly, I'm sorry.
I really don't need it to taste like grandma at all. That's just, let's just go with the black raspberry, period.
Exactly. All right, so moving on to some serious stuff here. So we got to get into some of the market moves, the trending, where things are going. And PE is something that everybody looks at, price earnings ratio, the price of the stock or fund compared to the earnings. And is it growing? And as you can see, we are definitely at elevated levels. The chart on the upper left goes back to, 1999, so 25 years. And we are definitely in stratospheric levels. I mean, we've been saying this the last couple of weeks. We went and talked a little bit about, you were going into some of this with some of the trending information.
Yeah.
I think it's very interesting because, like we said, as long as the consumer spending, something's got to, for the catalyst, something's got to break. And in the lower right-hand corner, this is just now breaking it down by sector. And if we're looking at this, right, the blue line is bringing it to where it is in February compared to the 25-year average. And we can see here that we are extended and above and beyond the average PE ratio, even by sector. I don't know how much you use PE in a lot of your analysis, but it's not my de facto go-to, but it's certainly up there to know whether it's something is cheap or moderately or fair valued or overvalued.
Yeah, I think it's not as everybody puts a lot of emphasis on it. I don't put as much of an emphasis on it. It's something that's in the back of my mind always. It just the reality of this is the PE ratios for the things that have been really running fast are just off the charts at this point, and they're priced for absolute perfection every time. And I think what we see is if they come in, give you an example, Nvidia 2 weeks ago, Nvidia comes in with just blowout earnings, and good on you. They went a long time not even being known by people. If you look
They
at a
flew under the
long-term
radar for a
chart,
decade.
yeah, it was at least a decade and a half of them sitting in that below $10 to $15 range forever. And it's just been this last few years with AI that they just happen to have an unbelievable chip or chips for AI. And of course, everybody's scrambling to do stuff in the AI world right now.
Well, I think it was 20 years ago. I saw a chart. I think Nvidia was under a dollar.
Yeah. Yeah. And it
Maybe
was
that
just
was in 2001, somewhere
they
around
were
there.
they were just another chip maker. They were weird. They were making stuff that were so advanced for the time that we just didn't have the computing capability to really use what they were doing. And the world finally caught up to them, and they're priced for perfection. They keep blowing the doors off of their estimates and everything else. And I honestly think they don't even necessarily come into it going, hey, we're gonna pull back a lot. They're still putting out estimates that are like off the charts huge. They're telling us that, hey, we're gonna see a 15-20% raise on a multi-trillion-dollar stock at this point.
Right,
Uh,
but I think their stock price is like big boy pants right now,
yeah,
and they need suspenders to keep these things up because they haven't
sure.
grown into them yet.
Yeah.
And they're expected to. Look, they're the leader. They're going to be out there for a while, but we've all seen what happens with ebbs and flows.
Mm,
People have been cutting into Amazon. Walmart is now a major competitor online.
yep.
Just take a look. Google search. Now, people are thinking, maybe is Google search dominance in danger because of the AI? Come
Mhm.
on, people, please. These are headline movements of the stock price. These companies aren't going anywhere. They're only going to keep growing and getting better. But
Yeah.
they're already talking with NVIDIA about AMD and several other companies. Their AI chips will catch up eventually.
Oh yeah.
Of course they will. Of course.
Yeah.
It's just the nature of it.
Yeah, and it's the nature of the beast. Right now, Nvidia is the leader when it comes to that. The point I was getting to is all of these things that are in that kind of information technology space are priced for absolute perfection. And when they don't meet, even if they meet expectations, but they guide down for the future, these things get poleaxed. There's days where you're seeing things down 12 to 14% in a day.
And
Yeah.
there will be a pothole and it steps in, whether it's profit
Yep.
taking, algorithm, computer, models just going in to say, you know what? It's due for a 10% pullback. We'll buy it back at 10. It's going to
Yeah.
happen. It's going to happen. A couple of other things here. We went through earnings growth, PE. Now we're looking at sector level revenue growth. And
Mhm.
people, I know we talked a little bit about this, was the last week or the week before. I don't know how a barrel of oil isn't over $100 with everything that's going on in the world and in the Middle East.
Mhm.
I don't know. But here we go. The revenue growth, energy is the worst performing sector. And I think it's either been the worst or the top two or three worst performing sectors in 13 out of the last 16 or
Yeah.
17 years.
Yep.
But when it spikes, and right now we have we have a glut of oil, and then real estate and communication because of the interest rate sensitivity.
Mm.
So we'll have to see, but these will flip around. It will happen. But real estate has surprised me because of the
Yeah.
interest rate. But like you just showed before we were going over it, that real estate, new home sales are down.
Mhm.
And now existing homes have been down over the last 18 months because of interest rates and then 30-year rates being over 7%. But the new home builders are at all-time highs.
Mhm.
So I
Yeah.
wonder if this data is a bit of a lag effect. Your thoughts?
It may be. I think the other side of what surprises me of this is a lot of the real estate space that you're seeing here is measured by REITs, and those REITs are typically in the space of the commercial space. And it's interesting to me with the kind of shift away from offices and more either hybrid or other work that we're not seeing a hit on earnings and revenues in the real estate space.
So we'll have to
Yeah.
see. All right.
That's actually shocking to me.
Yeah, we've done this before. CNN has their fear and greed index, and like we actually needed a chart to tell people this, right? But we are at overbought levels. How
Sure.
we could stay up here for a while. We're at extreme greed, but if you take a look at it, a year ago, coming out of a horrible year, we were still at even greed then. We were
Yeah.
greed a week, the extreme greed a week ago. We were extreme greed a month ago. But the bottom chart gives you a 2-year look to see where we are. And obviously, you can see when we breach that 75 level, look, we see what happens here. It pulls
Mm.
back. It's just like a regular stock chart, right?
Yeah.
30 and 70 with the RSI, the relative strength index. You get above 70, you're in an overbought. You're above 75 here, you're in extreme greed. And
Mhm.
then, get your take on this, but we're in either greed or extreme greed on all these things.
Yeah.
And at some point, there's always reversion to the mean,
Yeah.
whether it's to the moving average, typically 50 or 200, or it's just going to get to the moving average of the channel that it's in. What are your thoughts?
Yeah. I don't think any of this surprises me. We've been having these discussions, but I just, once again, that starts to tell me these are all things that go into my look of the markets and what I see going on. And it's been awesome. I've loved riding this absolutely awesome wave coming into this year. But I think we're at a point where we're at our earnings season at this point. There's no major catalyst for another few months down the road. You've got a couple Fed meetings in here, lots of economic data. And I think there's a lot of room for the downside and not really as much room on the upside at this point. I think, as I said last week, I think we need to be a little bit more cautious. The Investors Business Daily, their chart of the markets pulled back from 100%, 80 to 100% in the market or in the stock market back to 40 to 60. I heed those warnings and I accordingly adjust portfolios to that because I just think we got some rough times that we're going to see probably going into the summer. I heard this morning a couple of the Fed governors talking, and once again, they're hemming and hawing about we might see a drop in interest rates a little bit later this year.
But they are standing their
Maybe,
ground.
yeah, maybe this summer. One of them said, the Atlanta Fed guy said maybe this summer, which the Atlanta Fed guy we always laugh at, but they've actually scarily been right on some of their weird off the
Yeah,
wall
the
stuff that
GDP
they come up.
numbers especially.
Yeah.
I will tell you, look, getting into late November, definitely December, every schnook, including us, will be considered the two schnooks too,
Yep.
always have their 2024 outlook for the market. Well,
Yep.
right now, with the rise that we had in the first 60 days, we're either near, at, and a few have already exceeded
Mm-hmm.
price targets for the S&P 500 for 2024. And wouldn't you know, some of the top schnooks have already raised their price targets based on the first 60 days. Dude, it makes no sense. What are you doing?
Yeah.
Who's even allowing this? Obviously, it's all manipulation to say, keep putting your money in and keep staying invested, folks. We're going
Yep.
higher. Pump it
Yep.
up, baby. Pump it up. Come on now. And the
Funny thing
problem
is,
is the average investor are sheep. They
I
just
don't
don't know.
remember. Yeah, I honestly don't remember what I sent to you at the beginning of the year or when we did our end
Well,
of
we'll
the year
pop those
show.
up soon. Maybe at the end
Yeah.
of each quarter, we'll pop those up.
Yeah. See where we're at. I think I'm already well beyond what I thought we would be for this year.
I'm right at the top end of where we're right at where the top end of my target was, almost there.
Wow.
Yeah,
So,
I still think we'll be there,
oh
but
yeah.
I don't think, I can't see another 10 to 15% move to the higher between now and the election. After the election's another story.
Mm.
But between now and the election, with everything that's going on, the discourse, the downtrending of economic data, and look, I said this last year. I don't know. I
Yeah.
don't know. There's still a lot of quality things that'll ride all this out, but somebody's going to step in a pothole here real soon.
And I think maybe the saving grace of it all is that you haven't seen as much participation in the broad market. It's really been last year and a half has really been driven by the infotech.
Some of the broad market has come up, but
Yeah.
I saw a stat that more than 50% of the Russell 3000 stocks are still 20% below their all-time highs.
Yeah. Yeah. There's the saving grace is maybe it's that we start to see a little bit more market breadth happen and that, but I think it's not going to happen that all of a sudden money goes from the high tech guys to, oh yeah, now we're going to spread it out amongst those other ones. Until we see a little bit of a pullback and people go, okay, we're losing momentum on those the infotech stocks.
Yeah, nobody is moving money out of tech and into real estate or utilities.
No,
right? Okay.
Not at all.
Yeah, that's not going to happen. It'll go somewhere else. But
Yeah.
there will be rotations. It's just a matter of they're talking about how passive investing is hurting a purge with corrections because people are in the set it and forget it mode.
Yeah.
Which for long-term investors, that's the way you want to go.
Absolutely.
But even so, look, escalator up, elevator down. That could be a pretty steep fall when we get there. We'll have to see. Not wishing for it, but there are healthy corrections, which we've talked about in the past.
Yeah, that's just a normal effect. And like we've said before with our clients, I think they've gotten used to just this kind of steady uptrend. And all of a sudden we have a 5% pullback and everybody goes into panic mode. It's just,
the humanity.
Okay, that's just part of it. We're going to adjust and that's what's going to happen.
Yeah, I know. I think you got one more topic to cover.
Yes, I do. So one of the things that I've been doing a ton of experimentation with in really literally every part of my life is chat and learning how to do prompts properly and what's called pre-prompting and things like that. And so I was just sitting there and I said, you know what? I want to talk about something on the show. And I asked ChatGPT, what are the most common questions that are asked of advisors in general? And one of those questions, and I think it's apropos for what we've been discussing, the massive amount of credit card debt that we've had seen in this country and everything else, and I think around the world. And I just said, how do you get out of debt? So go back to some simplicity. So let me share this with you guys, and then we will go from there. So when I teach people about getting out of debt, there's really two strategies that can be used at that point. The first of which is what's called the debt snowball. So what's the debt snowball? It's taking all of your debts, putting them in order of the lowest amount of debt first, regardless of what interest rates are, anything like that, and putting them in the lowest amount first to the highest amount. Okay, stacking them up that way. Calculating up what your minimum payment is on each of those, and then basically saying, okay, this is how much I can afford to pay towards debt every month. Let's call it $500. So let's say $500 and your minimum payments were $450. So that means your net positive $50 that you can apply towards accelerating your debt pay down. So what you would do is you basically then say, okay, my lowest debt, I'm going to pay the minimum payment plus that $50. And until that's paid off, I'm just going to keep doing the same thing. Once that's paid off, I'm going to take what I was paying and on that small debt, and I'm going to apply that to the next one in line. And you just keep doing that. And so the debt snowball is designed as a psychological tool. And so this is one of the reasons I like it, because investor and financial psychology says that when I see success happening, I'm just going to keep doing it. Okay. So there's another strategy that's more of the thinking. I'll put it this way: the thinking man's approach to it. I'm going to pay off the highest interest rate going to the smallest. So I'm going to stack them by interest rate and I'm going to pay them off. So what I did is I've actually got a chart, or basically the book that I've got coming out here in the month of March. It's called The Overcoming the Retirement Trap. And one of the chapters in there in my Freedom Day method is how to get out of debt. And I shared, or I basically created a calculator that's free when somebody buys the book. They have access to it. But what I did is I went in and I created a calculator, basically a debt reduction calculator that helps you do this automatically. In this example, I've gone in, I've typed in all the different creditors that I have. I put in my balances, I put in the interest rates here, minimum payments, and then I effectively came in and said, all right, now at the bottom here, now it's in order of the debt snowball. And doing my $600 a month, my minimum payments are $445, my $600 a month that I can afford to pay. Now my snowball, that extra money I can pay, is $155 a month. So that tells me in this sheet, basically, that if I just stick with that, if I just stick with the snowball method, paying $600 a month towards debt, by June of 2029, I'm completely debt free. All of these things are paid off at that point. Okay. Make sense?
Absolutely.
Yep. So then I said, let's go ahead and do the avalanche and let's see what the difference is. Once again, I say it's the thinking man's way of doing it. Okay. One of the things right now is credit card debt is massively high, 22% in most cases, some cases even higher than that. I saw a thing from my bank the other day and they're like, oh yeah, why don't you get a business credit card with us? And I'm looking at the rates and it's like from 18% to 29% or something like that, which is insane. Why would I ever do that? But I get 1% back or 2% back every month. Thanks. But you're sticking me for that. Doing it the thinking man's way, same variables here. That other one was June of 2029. This is January of 2029. So still, I would be paying things off in 2029. The biggest difference there is I'm doing this paying off the things that have the highest rates. Now, what has the highest rate of my stuff up here? $9,000. So yes, it's nice to get that off the plate. The problem with that is paying down $9,000 out of $26,000 total is going to take a hell of a lot longer. And from a psychological standpoint, it can feel like you're pushing the snowball back up the hill in those cases. So that's what I believe when it comes to debt reduction. It's very simple.
Organization and follow through are the two key things.
It's paying attention to it. And I think a lot of people they get bills and they just keep paying them, and they're not paying down their debts, but they're paying an extra couple $100 towards their mortgage and all this. And it's stop doing that. Get this stuff organized. It's very simple. It's very straightforward when it comes to this, and it will help you to get yourself out of debt. And I'm more than welcome to anybody that wants a copy of this thing. I'm more than welcome to send you a copy of this. Just wherever you're listening to this, just put a quick note in there and we'll connect and I'll send you a copy of this. But once again, this is, I think, important to get yourself out of debt and get focused on it now, because if you don't, it's just going to come back and sting you here in the future, because it's just going to get worse and worse.
Yeah. Look, we've talked about credit card interest rates for a while. Carryover balances are over 1.1 trillion. The only way that really stops is two things. One, people are out of a job, or the credit card companies and the banks stop extending more credit.
Yeah.
But hey, they've got to make their quarterly numbers.
Oh, and that's it. And they're just going to keep doing it. I mean, and if you look at the financials, if you look at the big credit card companies, they're making a ton of money. I noticed the other day that Capital One acquired Discover, the Discover.
I don't think it's going to go through.
Yeah, who knows?
We'll see.
Yeah, they've got a good lobby and they'll throw money at.
If the GOP wins, it'll probably go through.
Yes, it could go the other way too.
We'll
remember,
see.
most of those credit card companies are headquartered in Delaware. So just saying.
I understand. I understand.
All right, folks, thanks a lot for joining us. Hopefully this was helpful for you. I'm going to continue to work down the list of things that ChatGPT recommended as frequently asked questions. We'll be sharing these on the shows, and what we're trying to accomplish is just give you a little education, give you a little bit of fun, and keep you up to date on what's going on in the markets. So thanks for joining us. Make sure you subscribe, give us an upvote, and we'll see you here the very next time.